We all have one goal in common. We all want to retire, to stop working one day. And in order to do so, we need to have enough income or income generating assets to make sure that we could still survive without working for our income. Today, we're going to talk about 401ks and what questions you need to consider before contributing to your 401k. Hi, I'm Olivia Kirk.
I'm Tim Urich. We're from Tier 1 Capital, and we're here to show you how to regain control of your money.
For the best advice on controlling your cash flow, be sure to subscribe to our channel and don't forget to hit that bell to be notified when we upload new videos twice every single week.
So you think that your 401k is the solution to all of your problems? Check out our latest blog post. We do a deep dive to show you that participating in the 401k could actually increase your problems. We'll see you there.
When it comes to retirement, there are a lot of tools out there that can get you there. Whether it's passive income with income generating assets, an IRA, a 401k. If you're a business owner, maybe you plan on selling that business one day. But today we're going to focus on the most common, which is the 401k, or similarly, the 403b.
You see, these are government tax qualified plans. And basically what that means is you can put money into these accounts on a pre-tax basis. So you get a tax deduction for the amount of money you contribute into the plan.
Additionally, once the money's in the plan, it's able to accumulate on a tax-free basis until you pull it out.
But here's the catch. When you get to retirement age, when you start accessing that money, every dollar you take out of that account in retirement is fully income taxable at whatever income tax bracket you are in at the time of distribution. What happens if taxes go up in the future? In essence, you deferred from a low bracket to a higher bracket. You lost there.
Not to mention, you put in a small amount, a seed of money that was able to grow and accumulate, and you were taxed on the harvest, a large amount in retirement, because hopefully between now and the time you retire, that account goes up. And by doing that, you're actually paying tax on a larger amount. Leave us a comment down below. What benefits do you see with using a 401k? Is it leaving you in more control or less control of your financial freedom? Another thing to consider is what happens if you need to access that money within your 401k before retirement. You see, these government tax qualified plans have rules imposed by the government. And one of them is that you're not able to access that money without a penalty before age 59 and a half. But between now and age 59 and a half, you have a lot of life to live. There are a lot of things that are guaranteed to come up, whether we know about them now or not. The question is, where are you going to get that money? Is the only place you're saving within your 401k account? Because that could leave you in a pinch.
Now, you may be able to access your 401k through a 401k loan. There are some limitations. Number one, the government limits the amount you could borrow to $50,000 or half of your account balance, whichever is less. When you're paying back that 401k loan, you pay it back with after-tax dollars. In other words, you get paid after you pay your taxes on your income each pay, then you pay back your 401k loan with after-tax dollars, and the money is now back in your 401k. But here's the key. In order to get that money out, you gotta pay tax again. If you think you're saving money by participating in your 401k, you're actually exposing yourself, if you need to access it through the loan, to double taxation. Is that what you want?
The other day I was speaking with a client and he was talking about how he accessed money through his 401k in the past. And it was all well and good until it wasn't. And he ended up defaulting on that 401k loan. What does that mean? Well, whatever balance was left on that loan was distributed to him in essence as taxable income in that year. And it exposed him to more income tax than he was ready to pay.
Because he also had to pay a 10% penalty on top of the income tax. Another question you need to ask yourself is, will the dollars you take out in the future have more or less buying power than the dollars you're actually putting in. Maybe you're not going to retire for another 25 or 30 years. Will the buying power of a dollar be greater or less than the buying power of a dollar today?
Well, to answer that question, you need to consider the effects of inflation, that our buying power is less than it was just a few years ago. Imagine the impact that inflation is going to have over the next 20 years on our dollar. We're going to need a lot of money accumulated in order to support the same lifestyle 20 years down the line.
Another thing to consider is, will taxes be higher in the future than they are today? We don't control it. Those geniuses in Washington control it. There's an old saying that in Washington, if you're not at the table, you're on the menu. Do you really want to subject your retirement to things that you don't control? You don't control inflation, you don't control taxes, and you don't control the rules for accessing that money.
That's a great point. With these tax qualified plans, there's actually no contract. There's tax law, which we know changes and changes frequently, and could very well change to not be in our favor. If you want to be in control of your retirement and your retirement income and make sure you're actually able to retire on a guaranteed basis, check out our website at tier1capital.com to schedule your free strategy session today. We'd love to talk to you about your specific goals and how we could help you reach them. If you like this video, check out these two. We picked them out special for you.
Thanks so much for watching our video. And remember, it's not how much money you make,
It's how much money you keep that really matters. We'll see you in the next one.